if you're having to explain this market and what makes it unique, like I've heard how you describe it, I've described it, like I've heard a million people describe it. And the way I just heard someone else describe it the other day is very interesting, that we are in a very unique space in time and history in the United States. We are in a space that most economists didn't think could happen. We have currently, we are simultaneously experiencing low inventory and low buyer demand. And so I guess put a different way, you're experiencing supply and demand that are both low. Like, I guess that's the best way to put it. Supply and demand are both low. So normally, if you have really high supply, right, what does that infer?
Not as much people looking to purchase.
Correct. But we have no supply.
Right.
And so we're just in this weird space that doesn't typically happen. So when, as agents, right, that's the first thing, if you're at a cocktail party, you're at a bar, what do they say? How's the market? The most honest answer you should say is, who the hell knows? I couldn't tell you. It doesn't happen like this. This isn't the way it's supposed to be. So the best way, I think, to describe this moment in time is that you have a lot of folks that are experiencing sub 4% mortgage rates. Which, by the way, I also learned is one of the largest undervalued or underappreciated asset classes in this country. And I say that because there is a value to a sub 4% mortgage to the average consumer. Is there not? I mean, it's what, if you have, you need one extra bedroom, but you don't have to have it. Let's say you have one extra child, you get a bunk bed. We're staying here. I have a 2.8% interest rate or 3%. We're staying. Like, I'm not doubling my mortgage payment to get one extra bedroom or double the yard. I don't need it. Like, I'm not. So it's worth a tremendous amount. And then don't get me started what investors are going to do. They're going to start assuming or transferring or subject to the mortgages in order to keep that asset with the property. I don't want to buy your house as an investor and you sell off your, and pay off your 3% mortgage, and I take a 8% mortgage as an investor. That's a tremendous hit to the potential value of that property. So you're going to start to hear, and hopefully folks will get very comfortable with understanding what that can look like, because that's an asset class that we can protect and get creative in terms of keeping the financing options alive, because some people need to want to move, and they're not going to because no one's helping educate them on what their options could be. And I just thought that was really interesting to see that we're in a really bizarro time that you have supply and demand totally out of whack. I mean, how do you describe that? Because I know people ask you, I mean, do you try to get into the weeds? Or do you feel that most people don't really want to get in the weeds? They just want to know the very essence, 2 or 3 sentences. And I'm like, man, I don't want a whole description of the economy.
So, I mean, right now, I just think a lot of people are backwards right now, just because during the pandemic, we were at record lows, right, on interest rates. And they know someone that got those 2.5% interest rates. So I think that a lot of people just say, now's a bad time to buy because my neighbor or my best friend got an interest rate for 3.5%, 3%. So they just think that, I'm going to wait until that comes back. So a lot of people are backing off the market. So when they hear these 7%, 7.5% interest rates, that's whoa. That's not going to be the time for me. I'm going to wait till they get back down there. And that's just, that's just something that they just need educated on. Yeah.
And so what we know about, now, remember, this is the normal world, not this weirdo, bizarre place we're in at the moment. But traditionally, interest rates and pricing, they don't go in the same direction. Right. So when interest rates are supposed to go up, the pricing should be pressured downward. That's what should have happened. And I guarantee you our Federal Reserve is not happy. They keep crushing they keep raising it at historically high pace, hoping to push down the pricing on homes. And it hasn't happened. So they're very frustrated because what in the world can we do? We've raised it like crazy people, and yet pricing has stayed. In some places it's increased, but in others it's just been stable. And that's the main lever that they want to do. And so it leads me to discuss, affordability. So what most people are like, that they're not really using the right terms. That we all talk about interest rates, but what we're really talking about is affordability, payments. So they want to say, okay, well, I'm paying, $1,800 in rent. What do most people say when they want to buy a house? They go, oh, can I have a house with a payment of $1,800? I'm comfortable. I'm used to that. And so what they're seeing is, oh my God, to get a house with a mortgage, it's now $2,600 or whatever. It's now dramatically increased, like for first-time home buyers. And so affordability is a main index to think about. And there's three parts to this, and this is referenced, a million times over, but it's something we as agents need to be able to articulate. And so there's three parts to affordability, right? And it's related to the house price itself, the interest rate on a mortgage, as well as the income of the populace. So those are the three levers. And so when the Federal Reserve is considering affordability, and there's indexes for this is just a simple way to think about it, is that they're going to look and say, okay, if home prices are continuing to be stable and or raise, and income levels of Americans continue to be stable and or raising, the other issue, like they're going to raise interest rates to lower one of those levers. You got to have one of those levers to go down.
Right. Something's got to give.
Something's got to give. And so are people like, what's most likely to happen first in order for people to have better affordability? One of those goes down. Our home price is going to go down. Our interest rate's going to go down. Or are the average folks, like their income level, going to go down? One of those has to happen.
Right.
Because we need affordability to improve. And right now, at this exact moment, it is a rough time for affordability. It's the worst time in America, not worst ever, but it's worst, I think, in 20 to 25 years. It's the lowest point of affordability.
Yeah.
And that's the pressure you and I feel, is people are referring to, God, look at that payment. They get excited to buy until they see the affordability factor.
Oh, yeah. And and even in the last few months, I've had a few people that have been searching, go back, run the numbers and see, man, the payments are just a little bit too high for this now. I need to go a little bit less or hold off for a little bit.
Yeah. And so what you need to also remember during this conversation is that Americans on average, I think the statistic, and don't shoot me if I'm wrong on this, but it's very close to this. It's about half of Americans, 50% of Americans have 50% equity in their homes.
Wow.
That's an insane number to think about. Mm-hmm. And the New York Times released this yesterday. I get a little bing every time they have a story. It's really annoying, but this one was good. I think there's a 38% increase in a 3-year time horizon during the COVID years for the average American. Now, granted, it's top heavy because the folks with assets are the top 10, 20%. They get the highest increase. They have the lion's share of that growth. But every demographic across the country, even the lowest 10%, saw a substantial increase in their net worth.